Hello everyone, welcome to the latest TM Brunston Market Update. I hope that you're all keeping safe and well during these troubled times, in particular with Russia and the Ukraine. I'm pleased to have with me once again Mark Shields, Investment Manager from Brooks Macdonald, who will be discussing some topical issues. Mark, stock markets are variable at the moment. Is there any direct Russian exposure in the portfolios?
The short answer, Brian, is very little. We have a very small amount of exposure via global trackers, which clearly would have exposure to pretty much every country. But obviously, the Russian markets make up an extremely small proportion of global indices. So there's very little exposure through the passive funds that we hold. We do have a very small amount of exposure in the Brunston Adventurous Fund through one of our emerging market positions that holds around about 5% of its fund in Russia or Russian companies. So the overall exposure within the Brunston Adventurous is around about 0.25%. So very little indeed. Obviously, at the moment, we can't really do, as it were, very much about that due to the Russian market remaining closed. But we don't have any exposure to dedicated Russian funds, the majority of which have now gated at the very least. Or indeed, I know of several that effectively closed and are looking to be wound up as and when they can. So the exposure we have to Russia is very minimal in the Brunston funds.
Okay, thanks. And one doesn't know how long this conflict will continue for. Are you, as the investment managers, planning on making any changes as a direct result of the situation in the Ukraine?
Probably not at the moment. I think I've mentioned in the past that geopolitics often comes down to a bit of a sort of coin toss, as it were. And you quite often find that you have short, sharp corrections with markets selling off quite heavily off the back of an event such as this. But then it tends to be that the markets subsequently recover quite quickly once again. So we want to avoid the tendency to make a snap decision or to try and position the portfolio one way or another, because inevitably it comes down to a coin toss, and we would rather be focused on the fundamentals, the longer term picture, and not try to get bogged down with maybe the idea that Russia's going to be in Ukraine for longer than it necessarily is going to be, or any other sort of outcome from this. So the short answer is no. We want to be remaining focused on the longer term picture, remaining focused on the fundamentals of the companies that we're looking to invest in, rather than trying to dissect the kind of minutiae of an event such as this.
Obviously, there are other impacts on the market at the moment, such as inflation and interest rates. What are your thoughts on the medium and longer term impacts on markets and the economy, Mark?
Yeah, so I think this is part of the reason why we've probably seen increased souring of sentiment over the back of Russia's invasion of Ukraine. Largely because obviously Russia is a major exporter of energy, it's a major exporter of commodities, it's a major exporter of agriculture and fertilizers. In fact, Russia and Ukraine combined are the world's largest producers of wheat, for example. So there's real fears that the knock-on effects of a prolonged conflict and indeed prolonged sanctions with Russia will result in increased inflation. We're seeing energy prices, energy being the sort of most direct route, but we're seeing energy prices going up. We're seeing over the medium term, we may well see commodity prices increase. And this is likely to have a more prolonged impact on the inflationary story. And clearly, we've seen markets in 2022 suffer off the back of concerns over a higher inflation, essentially. So it could be that the events that we're seeing at the moment in Ukraine are going to potentially exacerbate the inflationary story, or maybe indeed prolong the inflationary story. And one of the big questions we've got at the moment is the extent to which central banks will be willing to look through some of that short-term inflationary impact to focus on the longer term picture. And at the moment, we don't really know the answer to that, but we will probably know a little bit more when the Fed meets in the middle of March in the next couple of weeks. And it may well be that, given what they say at that event, we will get a greater steer as to where we think some of the inflationary narrative may well head. I mean, also, I don't want to sort of say that an event such as this presents some opportunities, but equally, I sort of think whilst the near term, I fully accept that near term governments are going to be focused on obtaining energy as cheaply as they possibly can. But I think this sort of event probably very much plays into the renewables theme that we're looking at the moment in our portfolios, because I think that increasingly countries are going to be looking for energy independence, and largely for the vast majority of energy importers, such as Europe, that's going to come about through the development of their domestic renewable infrastructure and energy sources. So, that's another area that I think has once again come back into the fore. We've got some exposure to that sector in the portfolio. And indeed, I think if you want to focus on the medium to longer term, that's a good area to be focusing on at the moment, we believe. Indeed, and other areas like cyber security as well, where we've got exposure to through our tech funds. So yes, in the near term, there's quite a bit of question over the economic and the market impact. But again, I think over the medium to longer term, this is potentially playing into some of the themes that we have within our portfolios.
Okay, yeah, it takes a lot of thinking towards the self-sufficiency of companies and countries, of course. Okay, Mark, that's good. That's a good précis at the present moment. I thank you for that, and I thank you also for watching. As always, if you have any questions or queries, then please be in touch with us. Thank you.